are prices of multifamily properties, are they going down? Cap rates might finally start to rise again, according to GlobeSt. Well, you heard it here on the Gray Report about a month ago. The cap rates have already risen.
Yeah.
Cap rates have already risen, depending on your market, depending on the asset, 25 to 50 basis points. That's what we're seeing across the board. But that's after we've seen an incredible amount of cap rates declining or compressing. And just as a reminder, when cap rates go up, prices go down. And when cap rates go down, prices go up. It's that metric that we use to evaluate all types of commercial real estate, as well as multifamily, which is a sub-asset class of commercial real estate. So they're saying cap rates might finally start rising again. Again, I think that's old news, but finally they were starting to report on it.
Yeah.
Cap rate data it's opaque. It's not accurate. It's incredibly lagging also.
Yeah, it's often old news. Yeah.
It's old news. It's oftentimes at 6 months, kind of in the past, because if you think about it, to get to the point of someone's reporting on a cap rate, first off, so we're looking at actual sales, not just offers, but actual sales. So a letter of intent gets issued, or let's even go further back. A owner decides they want to sell a property. They take it to a broker, several brokers. The brokers create what is called a BOV, or a broker opinion of value. It's basically a proposal saying, I want to list your property. I'm going to get it sold. This is what we're going to do. And this is what we think we can sell it for. Okay. So they've got an idea of a price based on their income, because cap rate is basically you take your net operating income, dividing it by your cap rate equals your value, or you can chop up that formula a couple different ways to provide any of those three variables between cap rate, purchase price, and net operating income. So they've got a cap rate in mind based on current financials at the BOV. Then they take it to market, have conversations, they get LOIs. Okay, so now that's another indication of price in your cap rate. But then it's whatever the price it actually goes under contract for, which may increase or decrease depending on where the market is. But then it takes, so by the time it goes from BOV all the way to actually closing, let's fast forward, that could easily be 4 to 6 months, like easily.
Oh, yeah.
Because just the process of once you go under contract, you have 60 days. It could take 30 to 45 days to market it and do the LOIs. So we could easily be looking at 6 months. But then even to get to the 6 month point, a lot of brokers don't, the information, it's not like it's public information, like this property traded for X cap rate, or even the purchase price is oftentimes disclosed. And so we're relying on self-reporting in most cases. And I know many even brokers will give false information because they don't want people to know what price.
Yeah, there's a lot of people that are interested in keeping that amount obscure.
Yeah, so the cap rate just data, especially historical data, it's pretty garbage. And I mean, if you go on like a lot of the data analytic websites, like a CoStar, that show the cap rate, like they're so wrong, it's laughable. They're so unusable. They're like consistently 100, 150 basis points higher than they actually are. You can use cap rate surveys that kind of people give an indication of where cap rates are, and brokers will kind of tell you. You have to use a kind of handful of different data sources, understanding of really what's going on in the market. It's a fluid number. There's not like one cap rate. But what we know is with rising interest rates and cap rates so low, you can't justify the purchase without using a high interest rate loan, relatively high, and a low cap rate. Like it doesn't pencil, and the cap rates have to come up to get the financing to be able to close. And so it's a pretty natural, cost of capital issue. Yeah. Now there's an incredible amount of demand from the renter and the investor side, but that doesn't mean people are going to accept, very low single digit returns. Yeah,
well, I mean, for the CRE side, the rise in interest rates have cut down a large population of investors and buyers that were able to pay because of leverage. Yep. And now with that smaller pool of investors, that means lower demand. Yep. I don't think that the people that can make it work are able to make every single deal and account for everything that was lost from the investors that weren't unable to make it work. Yeah. So as kind of an overview of each different asset type, multifamily and industrial assets, according to this article, set first quarter price growth, which is great. That's a story. But the office and retail were a drag on CRE price growth. It does note that industrial square footage under construction could slow price growth, but reading between the lines, they say office and retail drag on price growth. They say the industrial asset prices are going to go down. So where's multifamily? Multifamily, the only thing they said about it is that it had record price growth. I think that the increase in interest rates is a market shaping force in and of itself, and so that's going to result in higher cap rates for multifamily properties. But it doesn't have those extraneous forces like an relative increase in supply in industrial, or the kind of sluggish performance of retail and office.
One beneficial part of all this is I think we're getting some really good insight of the conversation of the correlation or causation discussion between interest rates and cap rates. Because for the longest time, there was an assumption of, there's some correlation there. And then it's like, well, maybe not as we thought. But we're now able to really kind of test it across different scenarios and extremes. And where the evidence seems to be pointing to is that it's really volatility that has a more of an effect than just what the actual rate is on pricing. Because I think if rates move up or down slowly, it has a very negligible effect, especially within a certain range. But at the rate of change in interest rates, I think does have a much more dramatic, and we're seeing it right now.
That's very interesting.
The switch has been flipped.
Yeah.
For rates, well, the switch has been flipped for us buying as well. Again, as opposed to that kind of gradual transition, because we saw a gradual transition, back in 2018 or end of 2017 into 2018, as interest rates were rising and rising and rising, but cap rates stayed flat and then actually continued to decline because there was more and more investor interest. The fundamentals were still solid, but it was kind of like a boiling frog situation of interest rates are a little bit higher and returns are a little bit lower, but just slightly. It wasn't enough that you weren't going to do a deal. Because like let's say you were, this was a couple of years ago, you don't see cash on cash numbers like this too often these days, but let's say you were underwriting a typical deal, you could hit 8% cash on cash, or let's say 8.5. Now that the interest rates have risen and now your year one cash on cash is 8.25. Well, are you not going to do the deal because of that? Or at 8%, it's still pretty good cash on cash. Are you not going to do the deal? 7.75%. It still looks like an acceptable deal. It has to really get to a point of dramatically lower. And again, over time, if you are willing to accept a slightly lower return, over a longer period of time, it's all relative to the last deal, whether that's from the buyer or the investor. So the investor's like, well, what did I get in the last deal? Okay, well, I was getting 7% cash on cash year one. Okay, well, that 6.5 doesn't seem that off. But if you go from 8 to 6.5, that's a big shift. And where we've gone from was a couple of years ago where you could get 8% out of the gate because 8% is a common preferred return in private equity, but especially in multifamily and real estate. And so a lot of times an operator, not always, not because you couldn't do this in every market, but like in the Midwest, we could typically get at least 8% cash flow year one, sometimes even more with an interest only. Wasn't too long ago, you could underwrite seeing double-digit cash on cash year one. If you're using moderate leverage, but then over time it was going from easily able to hit 8. We're really needing to see at least 8%, but then it was kind of 7, and then it was low 7s, then it was 6, and all of a sudden, when cash flow is in year one is like in the 5s, that's when we really started scratching our head of like this doesn't seem like the deal this isn't what we wanted to see. But now you're looking at a higher growth environment. You're getting better cash flow in later years. Cap rates have compressed. Oh, if you throw a low cap rate on there, it still makes sense. Well, now you're really getting into the area of speculation.
Yeah, that's well. In the same way, this is what I'm kind of thinking. In the same way for renters that are reaching this ceiling of rents they can't pay. Is there ever going to be a ceiling? I know cap rates are rising now, but the long-term trends where cap rates keep compressing. Is there ever a situation where like, well, I can't imagine they could go any lower?
I mean, we've been at that point a couple times over the last couple months. I mean, when the first time we were like, oh, that deal sold at a 5 cap. We were like, that's nuts. 5 cap, that's insane. And then all of a sudden, a couple years later, we're like, oh, a 5 cap, that seems like a great deal, like a true 5 cap. And where a year and a half ago, prior, we bought at a 7 cap, and then it's like, oh, it traded at a 4 cap. Then it's like, oh, well, mid 4s is now the norm.
Yeah.
And because the outliers, the 3 cap that sold. Oh, well, there's a 2.5 cap that sold. So, can they go low? I mean, are we at a point where it was insane? Like, yeah, we were at that point. But now we're saying someone could justify it. I don't know about the 2.5 cap purchase, but even that, if it's an incredible piece of real estate and you've got a business plan, because again, the cap rate is just a snapshot of in the past. It's not necessarily a predictor of future return.
If you think it's going to grow, or if you think you're going to sell it for more value, it's almost like these are becoming less cash flow and more about appreciation.
Well, that's how I think it turned over the last couple of years, is people were seeing like, hey, we don't have to hold on to this thing for 5 to 7 years. Hold on to it for, a year and a half, 2 years, and we'll just, crush a mid-20s, or low 30s IRR.
Yeah.
And just keep turning these things, because you were getting so much price appreciation so quickly, which isn't necessarily common historically. And because not all of it was like forced appreciation. It wasn't a value add. It's not like they fixed it up and they flipped it. It was they bought it and just rents naturally grew and cap rates naturally compressed, and it didn't really matter what they did. In fact, maybe the less they did, the better, because people were looking for more meat on the bone at the end of the day.
Yeah.
So the pricing, was much more speculative about selling it to the next buyer, being the core piece of the business plan of like, we're going to buy it and then we can get some cap rate compression, or we're going to flip it out in 2 or 3 years, versus at least how I got into the business, and kind of still the way I like to look at it is like, let's set up this long-term, cash flow vehicle to hold over time, to throw off cash over the next, 5, 7, 10 years. And there's going to be an incredible amount of price appreciation over time, opportunities to refinance and pull cash out. But it's not, how many times can we just flip and move in and out of properties,
Yeah,
because
it's completely another different way of seeing things, and it's a little scary. It seems a little more risky if you're separating it from the cash flow that's supposed to be the foundation of the investment, and if it's not providing that, then what is it?
Yeah, it's just the thought that someone's going to pay you more for it. Down the road. So
wow,
and that's how I think a lot of the economy has gotten into this situation that we're in. Is that whether it's stocks or crypto or anything.
Yeah.
Someone's going to pay me more at the end of the day, because my buddy down the road just made, 100% in 3 months.
Well, and if you want to generalize it, this may be, the trend of higher cap rates may be following the general trend of away from growth to value stocks. I think that seems like it would make a whole lot of sense in a higher.
Why would environment. I think so? I mean, why would it be any different from anything else?
Yeah.
We're not in a vacuum. Maybe uncorrelated from the stock market, but just general economics.
Yep.
It's all intertwined and interconnected.